Good morning, everyone. Lovely to see so many of you on the line and to be back with you again for another in our series of monthly webinars on the buy-to-let market. Special twist today is we will be talking about taxation, which I know, well, I can see by the number of you we have on the line today is something very close to many of your hearts. So I've got an expert with us today, who I'll introduce in a moment, who's geared up to help you on as many of these issues as we can, given we've got about 45 minutes today. I'm just going to hand over to our Chief Executive, Angus Stewart, who's just going to give a brief update on what is going on in the buy-to-let market at the moment. It's pretty busy, Angus. I think we all can see that.
Yeah, absolutely. Thanks, Christine. And well, yesterday the Bank of England decided it wasn't going to increase interest rates, so it's still saying it. Base rates sitting at 0.1% yet again. I mean, despite inflation going up, so that's interesting. And what we're seeing in the market is an awful lot of competition. There are lots of people coming out with nice low rates for you to take advantage of. Fees are dropping, so we're seeing continued product innovation there in terms of pricing. It's been interesting. We've got the stamp duty reduction, well, the first element of that at the £500,000 mark disappearing at the end of this month, and we know there's been a lot of delays in the marketplace in terms of processing. A lot of lenders have struggled with it. It's going to be interesting to see how much or how many people don't manage to complete by that 30th of June deadline. Clearly, if you've got a smaller property and it's a $250,000 cut-off is in September in England and Wales. Different things for in England, different things for Wales and Scotland, and slightly different rules there. What is also happening is we've got a very frothy market in terms of the property market, but despite that, we are still seeing quite a lot of surveyors down valuing properties at the moment, and that's interesting. I think they're erring on the side of caution. They don't quite know what's going to happen when furlough finishes, and whether they're just protecting the lenders against a drop in property prices. But certainly, we're getting some of our customers a little surprised when they know that the house down the road just sold for X, and theirs is coming back at a slightly lower value than they were expecting. Lenders have been struggling with processing volumes. Typically, if we went back a couple of years, it might be sort of 3-month cycle to actually get through to get a mortgage. We're certainly seeing some of them stretching out to 5 months because the lenders have got problems, the conveyancers have got problems. They've still got a lot of staff operating from home. Offices aren't opened up yet. They're not as efficient as they used to be. So if you are putting applications in, bear that in mind. Trying to actually get through the whole process is taking a lot longer in certain situations and with certain lenders. And I know I've got customers who've found that a little frustrating of late. So I don't really want to spend too much time talking about the market. If you've got any specific questions, by all means, stick them in the chat and I'll try and help you. But I think I'll pass back to Chris because we really want to talk about tax.
Well, I guess we do. Thanks for that, Angus. Yeah, and just as a reminder, we've already got some questions in the Ask a Question box, which we'll kick off with. If you have a question, you can put it in the Ask a Question box, or if it's easier, put it in the chat box, and I'll monitor both of those as we go along. So I'm going to hand over we've got our special guest today, Anton Lane from the Edge Consultancy, and Anton is a tax specialist, and I love the fact on his LinkedIn page he talks about the fact he enjoys solving tax problems, because we need some help with that, I think. So Anton, do you want to say a few words about yourself and about Edge, and then we'll start taking some questions?
Yeah, sure. So I started my career, I guess it started at university. I did a course in taxation and revenue law, sponsored by Ernst & Young. The course had some awards and prizes. I won some awards, so I went to work for Ernst & Young afterwards. Predominantly spent my time in their London office, worked in their think tank, their risk in tax intelligence service, and then moved to their Bristol office before joining PwC's trust arm as an equity holder. And an American friend of mine turned around and said, why are you setting up a tax practice for other people? So I set up Edge, ages ago. At the same time I set that up, I got invited to speak to groups of property investors, lecturing on tax and asset protection. So I've done that for something like 18 years now. I'm also a published author, not my own books, but through Tolley's, LexisNexis, etc. And if you Google my name, I just appear all over the internet on taxation. So it's become my life.
Oh dear, I don't know what to
say.
Well, I know we've got people on the line who are glad that you feel that way about tax. So I'm going to kick off with some questions we have. In fact, the first 3 questions here, I think, Anton, you can see them if you open up the question box. They're actually about capital gains tax when you're a landlord who has rented out a property that you once lived in. In fact, Martin is saying that this particular property was his main residence. So what are the rules around that you need to know about, Anton? And I don't know if you look at Martin and Chris and Raj, I think the first 3 questions are specifically on that issue, whether you can give them some advice specifically for them and generally for all of us who might be in that position of having rented out a property we once lived in.
Yeah, so when you're in a property that is your main residence, the duration that you live in there as your main residence is apportioned for capital gains tax purposes. So if you take the illustration from Martin, he says that he's owned the investment property for 13 years, but for the last 6 years, he's residing there. So those 6 years will be outside the scope of capital gains tax because it will qualify for something called your principal private residence. You also get a deemed period of occupation for property ownership. So if you own a property as your main residence, you will get a deemed period of occupation of 9 months because it was your main residence. You also get other periods of deemed occupation. For example, if you were working away from where your main residence is in full-time contracts of employment, you can get the same relief for self-employment or overseas employment or services. In Martin's case, it's quite a simple case of working out the total gain, which is obviously sale proceeds less cost, which include legal fees, stamp duty, land tax, any capital expenditure in the property. So, for example, if you had the roof repaired, an extension put on it, or anything like that, you'll get relief against the capital growth. And then you're going to divide that gain by the number of months. So if it's a complete 13 years, I've got my calculator handy because I'm legal background, not accountancy. So that's 156 months. So you divide the gain by 156 months, and then you multiply by 72 months, being 6 years, plus the 9 months deemed, and that is your exempt amount of a gain. Martin goes on to say that we pay tax at 20%. You pay capital gains tax on property at either 18 or 28%. Got to remember our numbers. You also have an annual exemption for capital gains tax, which is currently 12,300. So whatever gain is calculated as taxable, then you can take off the 12,300. The balance is used, and this is where it gets complicated, is used to go up to your first band, your basic rate band, which is about 50,000, including the personal allowance. And that is taxed at 18%. And then anything above that is taxed at 28%. Fortunately, the next question from Chris actually has some numbers in it. So I've actually quickly worked through the calculation, which will hopefully help Martin understand how that calculation works. So I don't know if you want me to run through that now.
Yeah, yeah, you could. That would be fabulous.
So if Martin's listening, you might want to take notes on this. So we have a market value or a hope to sell price of 375,000, and we have a bought for or a cost of 120,000. We don't have any legal fees or stamp duty landed or capital expenditure, but they would reduce the gain. So it's 375,000 less 120,000 gives you 255,000. In this illustration, there's 252 months, which means that the gain per month is 1,012. Okay, the period of months that it's been occupied as the main residence plus the 9 months, which is deemed, comes to 165 months. So if you multiply the 1,012 rather by 165 months, you get 166,980 that qualifies for principal private residence relief, leaving a balance of £88,020, which is subject to capital gains tax. You get a 12,300 annual exemption, which reduces the taxable amount to 75,720, and that will be either taxable at 18% or 28%, depending whether you're a basic rate taxpayer or a higher rate taxpayer, or whether the gain takes you from the basic rate to the higher rate. So in this illustration, the maximum amount of tax you pay is 21,201.60. Ta-da.
Wow, I think I followed that. there is a calculator on .gov.uk. Does it work in the way your brain seems to work, Anton?
No, nothing works like my. I think the issue with any calculators is, and it comes back to the point I made earlier, tax is law, it's legislation, and the interpretation of legislation requires some thinking. It's not a case of black and white and how to pigeon things into boxes. So that's why I say I'm not an accountant, I'm a chartered tax advisor, I'm legal background.
If this property was owned in joint names, husband and wife, presumably they could both have a personal allowance for capital gains tax, so they could reduce it a bit further.
So they will both have their own annual exemption. That's a 12,300. They can transfer property between them exempt of capital gains tax. So they could look at considering the basic rate band and the higher rate bands, who is more tax efficient to have the gain. Okay, and then they can apportion it between them.
Yeah.
So that's where this issue of thinking, not just a calculator, kind of really comes in, doesn't it?
Yeah.
I mean, Raj also, we've got some details here from Raj about his situation. So I guess that's kind of similar, isn't it? Yeah, he's looked at the website and he's asking about the grace period and so on. So I think hopefully that will have helped you as well, Raj. We've got a question here about, would considering ONS house index based value assessment be acceptable? Is that, Raj, when you're thinking about calculating capital gains tax? Do you think that's what he means, Anton?
I think it probably means the date when it changed from the principal private residence to a rented property and what the value would be of the property at that time.
So technically, I gave an overview of PPR relief, principal private residence relief, based on apportionment. So just, and only touching on this because of Raj's comment, technically, if you looked at, I would say Martin's, but it's not, it's Chris's situation. He bought 13 years ago, so that would have been around 2008. At 2008 was the last financial crash, and the property market was affected quite a lot. So HMRC do have the power to turn around and say we're going to take market values. So they could say we'll take the market value at 13 years ago, which would have been the cost. But again, they could say we'll take the value 6 years ago, and that might have been that might result in a higher amount being subject to not being subject to principal private residence relief, but attributing a higher gain to the period of the letting. So they do have the ability to choose between either an apportionment or actual values. The ONS House Index is one. The Halifax Price Index is also a good factor. Zoopla, etc., all have good historic values on. I think Rightmove does the same now as Zoopla. Yeah. So collect the data of the values at the various times relevant to your capital gains tax computation, and see what the best outcome is.
Okay, that's great. Well, thank you for that question, Raj. That's some really, really good points there. Something from Paul here before we sort of leave capital gains tax. Paul, if I move abroad and then sell UK property, is it the case that capital gains tax is deemed payable on the gain from April 2015?
Yes. There you go. So actually it's April 2016 or 15? But UK property is now within the territorial scope of UK taxes. Okay. So regardless of where you are or how it's owned, it will be subject to UK tax.
Okay, brilliant, great. Let's move on. Another question that was lodged in advance, and I think this is going to be an interesting one generally, is around the idea of setting up limited companies to manage your property. When is it a good idea to do this, Anton? And perhaps when is it not a good idea to do it?
Yeah, it's probably the most frequently asked question over the last 20 years. When to use a company, or when do I incorporate my property portfolio? So if you went back to when I first started lecturing on property taxation and this question would arise, we would tend to say when you get 5 or so more properties, then you might look at buying the next one in a limited company or incorporating. However, nowadays, the factor depends on what you're trying to achieve. Are you trying to achieve compounded growth? i.e. that means growing your portfolio, reinvesting the income and or gains into future properties at the lowest tax rate? Are you looking at an income strategy, i.e. replacing your earnings with property rental income, thereby having that lovely term, financial freedom? Are you looking to are you looking to pass your assets on to the future generations, create a family wealth legacy? So they're the type of considerations that need to be taken into account. Broadly, if you own property in a company, you get a deduction for the interest on the mortgage, which you don't if you own a property either in your personal or partnership name. However, even though you will have lower taxes or more expenses rather on your profits, if you need the money in your own hands, i.e. you need to take it out the company, you're going to be having to consider whether it's more tax efficient to go through the route of corporation tax on the profits with the deduction to interest, and then the dividend tax on taking the money out of the company. If you're a basic rate taxpayer, and you're not going to become a higher rate taxpayer, then it's really marginal. I did a calculation yesterday for someone who was earning 65,000 in a buy-to-let portfolio in their personal names with their spouse, and I did the calculation of incorporating it and taking the money out of the company because they needed to live off, and it came out £1,000 better. if you don't need the income, so you're already a higher rate taxpayer and you're doing this for future wealth building, by having the money in a company and reinvesting in property and just building that pot, then obviously it gives you compounded growth at the lower corporation tax rates. It also has the advantage when you look at the longer term, giving away shares in a company to family members in a controlled manner is far easier. So you could give away shares subject to shareholder agreements. You could give away shares in small amounts to trust. So you could, for example, give away your nil rate band, which is currently 325,000 every 7 years, into a trust to reduce your estate for inheritance tax purposes, and hold those assets would then be held in a family trust in a controlled manner, which you could make a protective trust. So if you were fearful of future divorce, creditor claims, bankruptcy against beneficiaries, you can do some level of protection within a trust. You could also stop the value of the shares or your shares in a company growing. You could create a class of capital growth shares. These shares would basically take all future growth in the company would be attributed to a new class of shares. So you could create a class of shares, let's say just B shares, that have the right to capital growth. You could put them in a trust or into another structure or outright to your children, whatever suits. And the value of that share today is nominal, let's say £1, but all the future growth attributes to them, and you've just done some estate planning.
And Anthony was asking that question about children as shareholders and the role that might play in approaching inheritance planning. So I think you've given.
Or is that? So somebody made a comment about giving shares as well to a 2-year-old.
Oh, right. I haven't seen that one yet, but again, a children's related question. What's your view on that, Anton?
I'm adverse to it. A 2-year-old can't sign a shareholders agreement. They can't elect as vote as a shareholder. They can be a shareholder, although what normally you would do is have those shares held on bare trust by a trustee or into interest in possession or discretionary trust, or if you're the grandparent, into a grandchildren's trust.
Right.
You need some sort of legal influence when you're a shareholder. A 2-year-old they can't sign things yet.
No. Okay. Well, clearly what you're highlighting here is how important it is to decide on your objective and to structure the company accordingly. So it isn't just about let's have a limited company, is it?
No.
And I mean, another question that's come up a bit is the difference between limited companies and SPVs. What's your view on that?
Yeah, I mean, I can answer that question. There's some other things to consider about limited companies as well. Do you want me to answer that question and then talk about incorporation a little?
Yes, please do. Yes.
Okay, so SPV stands for Special Purpose Vehicle. It is a reference used to a company which is set up for a specific purpose. So that might be, I'm setting up an SPV to do a development project. It's just a term. Doesn't mean anything else. It's just a term for a company. And what you're going to use it for, I guess, a special purpose. Incorporation. So all property investors at the moment have been kind of thinking about incorporation. And in my career, I deal with tax risk quite a lot. So I always look at tax planning and tax solutions in a manner that would limit or reduce risk. It's all very well doing some planning, but if HMRC are going to raise an inquiry, you've got to be prepared to defend that inquiry or suffer 2 years of questioning and tax interest and penalties probably at the end of it. So there's a lot of people in the marketplace that are promoting various ways of incorporating. And so I'll be honest, actually, some of the fees are astronomical. Okay, incorporating a property portfolio is complicated, but it's not professionally a massively expensive thing to do. Okay, so there are substantial fees, but not massively substantial. So I just raise that now. Sorry, I hate people mis-selling stuff in the market. So when you look at incorporating, you basically have a portfolio already, and you're saying that it will be better off if I own that in a company for various reasons. They could be the reasons that you're going to mitigate your tax on profits by having the deduction for interest. It could be the fact that you want longer term planning for estates, passing on assets to. It could be the fact that you've done it once or twice and you think, actually, as invested in property once or twice, and you're going, actually, longer term, if I do this in a company, I get that compounded growth. It's a better business decision to make. It's important to know the reason why. The way that you would normally incorporate a portfolio is stage one, form a partnership. You can form a partnership with your spouse. You can form a partnership by writing a partnership agreement with your partner. You can form a partnership by going into a limited liability partnership. One of the questions that arises quite frequently is, which is better, a formal partnership or going into an LLP? An LLP has the advantage that it is registered at Companies House. It's a legal entity. It's controlled by the 2001 Partnership Act or LLP Act, and it's visible. So you can't argue the partnership doesn't exist. But if you do a formal partnership, you have demonstrated a track record of that partnership exists as well. So it doesn't really matter which one you do. When you enter into a partnership, there's technically the property should change to the partnership name. And this is the first probably hurdle to get over before anybody thinks about incorporating, is what are your lenders going to say? So your lenders need to agree with what you're doing. At the end of the day, you don't want to be committing mortgage fraud. And if you do create a partnership but don't tell the lenders, then if HMRC do look at it down the line, they will say, well, you didn't transfer the mortgages. Are you sure you created a partnership? Mm-hmm. So just flag that now. So the reason you go into a partnership is because there's a Part 13 of Finance Act 2013 applies to stamp duty land tax, and it means that the amount of stamp duty that's calculated on going into a company works on what they call the lower sum of the lower proportions, which is absolute gobbledygook, but it basically gets rid of your SDLT liability. And then in order to get from the partnership to the limited company, you want to be qualifying for something called incorporation relief for capital gains tax purposes. Because otherwise you've got a deemed disposal at market value between connected entities, the partnership, and a company of which you're a shareholder of. So to qualify for incorporation relief, you've got to operate your property partnership as a business, which means you've got to be hands-on. If you outsource all the work relating to your property portfolio to a management agent, or a letting agent, and they do everything, find tenants, look after the tenants, maintain the property, etc., etc., you are not operating a business. So you need to look after the tenants, you need to organize maintenance, and you need to possibly have a business plan. and how you're going to develop and grow your business, your property business. So it could take a year or two to be able to demonstrate that you've got a property business once you're in the partnership. Assuming you can demonstrate that you've got a business, you should qualify for incorporation relief, which means that where you receive a new issue of shares in return for the property, the gain will be effectively held over, which means the shares take the base price of the properties, and the company acquires the properties at today's market value. If you are operating a property business, that does mean that technically you might sell properties at times and reinvest in other areas that might have better growth going forward. So looking at areas that are affected by concentric circles and stuff like that. So for those people, when you incorporate, if your company is taken on at market value and your company then looks at a subsequent sale, is going to realize a lower gain, if any gain, than you would have done if you were sold personally. So if your strategy is to reinvest, then incorporation could have advantages for capital gains tax purposes. However, the base cost of the shares is that of the properties, and therefore when you give shares away for estate planning, you've got a larger gain to deal with. But if you give away over a long period of time, you've got your annual exemptions you can use. If you give away to trust, you could have holdover relief, which could delay the gain as well. That's a lot of information.
That's a lot of information.
But that's really helpful, Anton, in terms of enabling people who've got property portfolios in their personal names understand the process that they might want to think through to get them into a limited company over what it looks like quite a significant period of time.
Yeah.
Actually make sure they abide by HMRC's rules on that.
Yeah, we normally advise people go over at least one tax year. So you get to file the returns to demonstrate the partnership, etc. There are two things going on in the market at the moment that you should probably be aware of. One is a hybrid version of incorporating where the properties remain in personal names or partnership names, but a company becomes either a management or the beneficial owner. So i.e. a trust relationship. And I come back to my earlier comments on mortgage fraud, but also on HMRC attack. So if you're not ticking the boxes on the way that it's actually done from a legal perspective, because you're trying to get the best of mortgages in personal names, but the best of the tax treatment within a corporate entity, then HMRC are more likely to attack.
That's very interesting. You've got to be careful, basically.
And if somebody was new into the marketplace and was looking to purchase a property, it really comes back from what you were saying in terms of purpose and what their current tax rate is as to whether they do it in their sole name or a partnership or a limited company, presumably.
Yeah, I would say 9 times out of 10, you're probably looking at going into a limited company now with the way the tax laws are. However, the biggest issue, which is where you might be able to help, is lenders. Getting the right lenders. So the amount of people that we've spoken to about incorporating, and one of the first things we say is talk to either your broker or your current lenders and see what their views are. And they've come back and they've hit hurdles. We had one yesterday that we told to talk to lenders, and they've come back and just said, well, the high street lenders aren't lending to a company.
We have a number of lenders who will.
that's the advantage of going through brokers rather than directly. But that's not me giving a sell pitch for you. But it is.
I was going to ask Angus, I mean, what is the situation with, because it used to be only a small number, it is getting a larger number, but, tell us a little bit about those lenders and what they want.
Absolutely. It's growing every week in terms of the number of lenders that are willing to play in the limited company space. What you do find is it tends not to be the high street names, as Anton says. We deal with about 100 different lenders and information on our system. And so we've got 30 plus who will do stuff with limited companies within that. And what you do need to remember is, the SIC code or industrial classification code, which you use for that company, is really important. There are very few lenders who are willing to consider lending to a trading company. So if you already own a company, don't think you can put the property in there. I do have one or two who will consider it, but it is a much more challenging process to do that, rather than setting up a specific company on a property industrial classification code, which is what they expect. The other thing to bear in mind is there are lots of tax benefits, as we've talked about, of doing stuff through a limited company, but the interest rates tend to be higher than if you're doing stuff through a limited company than if you are doing stuff in your sole name, if you are relatively straightforward. Holiday lets, for whatever reason, seem to be similar interest rates, whether it's sole name or limited company, to the stuff I see in limited companies. But you need to do the sums. And I think the whole point of this seminar is to understand that tax is really important as part of your decisioning process, and understand that, and then you can look at the overall costs of putting stuff into the limited company, understand where it goes, and then you've got the tax relief that you can get on that interest, which you can't when you're doing stuff in your sole name. So I'm afraid, is get your calculator out and understand your strategy, where you're going, what the best route is, and what the sums look like, understanding your own personal tax situation.
There was just one scenario you raised there, Angus, and that was a trading company owning an investment property. Just to highlight, from a tax perspective, it's a bad idea. We spend a lot of time extracting investment properties from trading companies. When the trading company is going to be sold, it's a very difficult process, either involving a capital demerger, seeking clearance from HMRC, or going through a Section 110 Insolvency Act demerger, which then obviously raises flags, even though it's a solvent liquidation, because you're using the Insolvency Act, that raises concerns with lenders. So we spend quite a bit of time advising people on group structures, separating out investment companies and trading assets.
That absolutely makes perfect sense to me. So we do get people coming to us who, for one reason or another, want to use their trading company. And
which is great.
People go and get tax advice. It's not our...
Yeah. Well, I was going to say, put a holding company in place and have a subsidiary.
Absolutely.
So there are ways. I mean, what other than limited company, obviously landlords are looking to minimise their tax and manage their portfolio the most efficient, cost-effective ways. I mean, other than limited companies, what other options are there? I mean, Raj is mentioning SIPs. What other things can you do? Is pension? Is that anything you can use? Are there any options there?
So rental income is not, so rental income, your own personal hands, is not income for the purposes of calculating how much you can contribute to a pension. So like Raj has suggested, he's a higher rate taxpayer, so he has other income. So he could contribute to a pension and thereby reduce his taxes on other income. You could set up a property business in a company, and the company could contribute to pension. So there is ability to do that. That can be quite tax efficient. Pensions nowadays, so you've got tax relief on the way in, you've got tax-free income and gains within the pension, and you can take out 25% when you crystallize your pension tax-free. You can also use pensions as an inheritance tax and estate planning vehicle. So they can either bring in other family members, or you can pass a pension on to family members. So the use nowadays is really, really good. the way that we tend to advise on the tax of pensions is companies contributing. So it could be a company owning a portfolio of property, contributing its profits to a pension for the benefit of the members. And then that pension, if it's a SIP or a SAS, may choose to invest back into commercial property, can't invest into a residential property. If developments are a possibility, you may have a DevCo, which is a trading company of which the SIP or SAS could lend to. So there are lots of flexibilities.
I mean, Raj has just added a comment there. So the tax on rental income cannot be offset by investing in SIP property in an individual name. I don't know if you could see his comment there.
No, but you are higher rate taxpayer. You said you're 40% taxpayer, so you have other income unless you're maximising your pension contributions into relation to that other income.
Okay. But a question has just come in into the question box from MK Wong. I am a non-UK resident and now invested more than £500,000 in UK buy-to-let properties through a number of vanilla limited companies. Those companies are held by me and my daughter, an 80-20 ratio. Is there any efficient way to deal with inheritance tax? Yes.
So if I'm right, you have UK companies. You're not UK resident. I read it or I heard it as you are probably a non-UK domiciled person.
I think so. The question box, Anton, it's the very last question. If you scroll down, I don't know if we've got all of those details from MK Wong, but can you see it?
No.
No worry, I'll read it.
Oh, hang on. Let me go back.
UK resident.
There we go. I've got it.
Got it. Fantastic. Very, very last question.
So you're non-UK resident. So MK Wong, I would ask, do you derive from the UK or you originate from overseas? I only say that because your surname being indicative maybe of Hong Kong or China. If you originate from outside the UK, you could be non-UK domiciled. Domicile of origin is taken from your father. If your father was alive at the age of your age 16, you take their domicile of origin. If you have visited the country that you've originated from, i.e. your father's originated from, that will be your domicile of origin in broad terms.
Yeah, it says Hong Kong. MK Wong says originate in Hong Kong.
So since you're a non-domiciled, we assume that you've got UK companies owning UK property, which is in the scope of territorial scope of UK taxes. You could put a offshore company in place to hold the UK companies and possibly set up an offshore trust or foundation. So that's the type of planning, but it's it's very complicated to go through.
Okay.
Would it make a difference where his daughter was based?
Not necessarily.
Okay.
So offshore. I wrote a Tolley's Tax Digest last year, I think. It was about offshore trust structuring and tax planning. The rules have changed significantly since 2017. But because MK is outside the UK, there is scope to just do stuff, but it's not cheap planning. It's very complicated, and there may be alternatives with things like shareholder agreements. UK trust may appeal differently. It depends on really what you're trying to achieve.
So lots to think about there. We've got a couple more minutes. If any more questions, please do put them in either in the chat box or in the ask a question box that you can see in the bottom right hand of the screen. I was just going to make, because there's been a lot of interest in holiday lets, because it looks like even though the UK government has opened up the prospect of holidays a little bit, not very much, we may not be going very far. I mean, Anton, what are the tax issues around holiday lets? Why is everyone talking about holiday lets?
I love furnished holiday lettings. So I added rather than holiday lets, I said furnished holiday lettings, because there's under the tax legislation, there's specific rules that applies to furnished holiday lettings. The rules are quite complicated of what qualifies, but let's assume that most normal holiday lets will qualify. If you manage your furnished holiday lettings, i.e. you engage people to go in and clean, you go in, get people to maintain the property, and you market the property to let, and that means that you might use holidaycottages.co.uk. That's not an advert pun. Then you would potentially qualify for business property relief for inheritance tax, which can mean the whole of the value of those properties is outside scope of inheritance tax. It could mean that you're undertaking a trade. So when you sell those properties, you could be within the scope of business asset disposal relief, which means the first 1 million of gain is only taxed at 10%. If you had a portfolio in your personal name and you wanted to do some estate planning, you can transfer into a trust without creating a chargeable lifetime transfer, because it qualifies for business property relief. The scope of tax planning with furnished holiday lettings is phenomenal.
I need to cover those things I wasn't really aware of there. I mean, Angus, so what's the lending market like for holiday lets? Are lenders responding to this demand?
Yeah, absolutely. Again, we're getting a number of lenders have come into the market on holiday lets over the last few months. They're seeing increased demand. We're certainly getting more customers coming to us wanting holiday lets. So no, it's a buoyant market. I mean, the other thing, Anton, I believe that if you've set it up your holiday let in the way you're talking, you qualify potentially for small business rates relief rather than having to pay council tax on the property, which again is another benefit. Yep. But clearly there's the contra to that is that I gather you need to have it available for rent for a certain number of weeks a year, and you're only allowed to use it for a certain number of weeks a year. And one of the challenges I've heard that got reported to me is that during COVID, the government was banning people travelling to holiday let or travelling at all, but HMRC have turned around and said, well, you still need to hit the minimum rental period, otherwise we're going to charge you. I don't know if you've got any comments on any of that.
I think it's be available to rent, and there's been some relaxation for things like COVID affecting that.
There have been. Okay, I hadn't realised they brought those in. I know at one stage it was being reported in the press that HMRC was being a little overzealous.
Yes, they can be, but the problem with HMRC is you might have one officer that tries something, which isn't necessarily policy driven. Okay. So rogue officers.
Well, last question. I think this is one for you. It's on a lender related issue. How likely is a lender to accept lending to a partnership, self and wife, given I have a consent to let residential mortgage? HSBC are the lender, if that helps at all, Angus.
Yeah, we do have lenders who will lend to partnerships. I'll be honest, it's nothing like as frequent as having stuff in your sole name or having stuff in a limited company. But there are lenders out there who will look on it in a similar vein to limited company lending. And by all means, talk to us in terms of looking at potential lenders.
I was going to say, from a tax perspective as well, where there is not necessarily, whereas husband and wife, you can probably do a formal partnership agreement without necessarily changing the mortgage arrangements. If you did a formal partnership agreement and signed the benefits of the properties to the partnership, you may not be in breach of the lending arrangements.
No, I'd say it's really important that you do all this properly. You keep your lender informed. As Anton mentioned earlier, they're very sensitive to potential fraud, and they record your case as one they suspect fraud on. It makes getting any mortgage from anybody else subsequently nigh on impossible. So just be very wary about what your mortgage agreement with the lender says, and don't deviate from that without specific agreement from that lender.
Yeah. And Dorota is saying, can we recommend a tax advisor to help with all this detail? And there is Anton Lane.
I have a lovely
Edge.
team of charters of excisers here in the office with me.
Fantastic, brilliant. Well, thank you both. Some great comments coming in how useful it was. There will be a recording for all of you. If you are one of our Property Master clients, you will get the recording. If you are not, please email info@property-master.com and we'll put you on our database. I look forward to being back with you again soon. And thank you so much, Anton. That was just so informative. And
thank you for inviting me.
Thank you. Thank you, Angus.
Thank you.
All again soon. Take care. Bye-bye.